Welcome back to our Tennessee Probate and Inheritance Guide series. If you've been following along so far, you hopefully now understand how probate works in Tennessee, from the court timeline to the steps that families actually have to take in probate court. Whether you're in Chattanooga or Knoxville or anywhere across the state of Tennessee, I'm here to make sure that probate is more clear and less overwhelming for you and your entire family. Today, we're tackling something most homeowners don't think about until it's costing them money, and that is the tax implication of selling an inherited property here in Tennessee and the legal potential landmines that can quietly drain tens of thousands of dollars if you don't know exactly what to watch out for. These small legal details can quietly eat away at your inheritance if you're not prepared. So let's walk through what exactly to look out for and how to protect yourself before selling an inherited property here in Tennessee. Now, over the past 8 years now, Jonathan and I have helped many families with everything from selling a home in probate to figuring out how to sell a home, an inherited house, without triggering unnecessary capital gains taxes. And I've seen every angle of probate real estate. Trust me, these mistakes can be the most expensive one that you can make. Just last month, I met with the family here in Chattanooga. Their home was in East Brainerd, and they were trying to sell an inherited home quickly. There was multiple heirs, and they no longer wanted to deal with the clean out, the utility bills, the monthly mortgage, and no one had explained to them at the time the stepped up basis rule the right way. And unfortunately, it ended up costing them over $18,000 in taxes that they did not actually owe. You know, that kind of mistake definitely sticks with you. It stuck with me, most especially when it's preventable. So in today's video, we are going to go ahead and break down 3 common mistakes people make when selling probate property here in Tennessee and how exactly you can avoid those. Now, my goal is simple. It's to give you the right questions to ask before you sign anything so you can make confident and informed decisions. And here's a quick note. I am not a CPA by trade or by license, and I am not an attorney. I'm someone who's just simply worked with hundreds of families through the probate Tennessee process, and we've seen what can go right and we've seen what can go sideways. So I'm here to impart our knowledge and hopefully save you a little bit of money. So let's start by clearing up one of the biggest misconceptions that I hear, which is that Tennessee eliminated its inheritance tax back in 2016. Well, that was welcome news for families back then across the state, but here's what most people miss. And that's just because there's no state inheritance tax, that does not mean that you're off the hook on paying taxes when it comes to selling an inherited property in Tennessee. Even without a state inheritance tax, you can still face federal capital gains taxes. And this is where most families tend to get blindsided. So the IRS applies something called a stepped up basis when you inherit a house. Understanding how to apply this correctly can mean the difference between paying thousands in taxes or keeping that money in your pocket. And if you remember the story I spoke about earlier, this can help you and prevent you from actually spending money in taxes that are completely unavoidable. So here's an example. Say your grandmother bought a home here in East Brainerd in 1991 for $45,000. When she unfortunately passed in 2024, it was worth $185,000. Your tax basis isn't $45,000 when she bought it, it's the $185,000 value at the time of her passing. So if you decide to sell the home for $195,000, you will only owe capital gains on the $10,000 difference, not the $150,000 growth since 1991. That's a potential $21,000 in tax savings. And what's the catch? Well, you will need proper documentation of that date of death value. And I've seen more than one inherited house lose this benefit entirely because the family couldn't prove the property's value when they inherited the property. On top of the federal rules, Tennessee charges a real estate transfer tax of 37 cents per $100 of the sales price. So on a $200,000 home, let's round it up so it's even, that's $740. That's not massive, but it does add up, especially when you add in county-specific recording fees. This is one of those property selling costs most people don't necessarily budget for, and it can certainly creep up on you. And here's another mistake that quietly drains families' wallets when they've inherited a property. It's not keeping up with the property tax obligation during probate in Tennessee. And I have seen this time and time again. Property taxes are due statewide across Tennessee every October 1st. So if your loved one passed in March and the probate process drags into the following year, you may be off the hook for nearly 2 years of property taxes. In Davidson County, that could mean $4,000 to $6,000 in taxes on a typical inherited property. And here's a pro tip. Some counties actually will allow you partial assessments when selling a home in probate. So Hamilton County, which is here in Chattanooga, one of our main markets, is one of the friendlier ones. And if you ask the right questions, they will potentially allow you to do a partial year assessment. Here's mistake number 2, ignoring capital gains and depreciation on an inherited rental or an improved property. So not every inherited home is a family residence, right? Sometimes it's a rental. Sometimes it's been remodeled or used to generate income over the years. And that's where there's another big tax surprise that shows up, which is capital gains and depreciation recapture. What most people miss when a property has been used as a rental is that the IRS assumes you've taken depreciation over time, even if you didn't actually claim it on your taxes. That means when you sell the home, the IRS expects you to recapture that depreciation. And in plain English, you'll owe taxes on that portion of the home's value that was written off for wear and tear. And here's the kicker. Even if you didn't take that deduction, the IRS treats it as if you did. So if the property depreciated $50,000 over the year, you could owe taxes on that amount at a rate up to 25% separate from your capital gains tax. So a quick example, let's say your father owned a small rental home here in Chattanooga. He bought it years ago for $100,000 and over time claimed or could have claimed, let's say $40,000 in depreciation. When he passed, the home's fair market value was $220,000. That again becomes your stepped up basis. Now, if you sell the home for $230,000, you might assume you only owe capital gains on $10,000, right? But if the IRS sees that prior $40,000 in depreciation, they can add that back as recapture income. That means you could owe taxes on $50,000 total, not $10,000. Roughly, let's say $10,000 to $12,000 in taxes, depending on your tax bracket. Now, here's how to avoid it. Before selling an inherited rental, you must ask your tax professional to review your loved one's prior returns to see if depreciation was ever taken. This is crucial. You should also get a fair market valuation for the property as of the date of the death, not just the sale date, to confirm your true basis. You should keep records of any major improvements like roof, HVAC additions, plumbing. Those costs can offset gains and reduce your taxable amount. Now, these small steps can make a big difference and they can turn a stressful sale into a clean, predictable one, even though it's really hard to navigate this when you're in the stage of grief. Bottom line here is that you don't have to be a tax expert to protect your inheritance. You just need to know which questions to ask your tax professional. And when it comes to inherited rental property or improved property, those questions can start with depreciation and documentation, like we've discussed. Now let's move on to mistake number 3, assuming you qualify for the home sale tax exemption. This one does tend to catch a lot of people off guard, even those who've done everything else right up until this point. The IRS allows homeowners to exclude up to $250,000 profit from taxes when they sell their primary residence, or $500,000 if they're married and filing jointly. What's the problem here? Most inherited homes don't qualify for that exemption because the heirs didn't actually live in the property before selling it. So here's the rule in plain English for you. To qualify for the home exclusion, you must have A, own the property for at least 2 years, and B, lived in it as your main home for at least 2 of the last 5 years before the sale of the inherited property. And if you inherit a property and sell it soon after, you most likely are not going to meet this requirement, which means that the entire gain after your stepped up basis could be taxable. Let's say you inherit your parents' home in Chattanooga in 2024. It's valued at $250,000, and when you inherit it, you sell it a few months later for $260,000. And because you didn't live there and because you haven't owned it for 2 years, you can't use the home sale exclusion, but you'll owe tax on that $10,000 gain thanks to the stepped up basis rule. Now imagine you hold on to that home for a few years. Let's say you decide to rent it out and then you sell it later, a couple of years down the road for $320,000. Well, you've gained $70,000 and none of it qualifies for the homeowner exclusion. That's where smart timing and documentation can make the biggest difference. So if you plan to live in the inherited property before selling it, you can sometimes qualify for the exclusion later, but only, once again, if you meet that 2-year rule. For most families, the better move is to sell it within a reasonable window after inheriting the home while the stepped-up basis is fresh and capital gains are minimal. And here's a pro tip. Always calculate the date of death value first and check with the CPA about the 2-year primary residence rule before deciding whether to move in or whether to sell it. It's one of those choices that can save you long-term tax consequences either way that you decide to go. The goal isn't to rush your decision, it's to make an informed one rather. And when you sell right away or move in for a while, knowing how the IRS defines a primary residence can save you from an unexpected tax bill later. Mistake number 4, forgetting how to plan for how taxes are reported and split amongst heirs, most especially when there are multiple heirs. Selling an inherited property is rarely a solo decision. I may have seen that a couple of times in my career that there was only one heir. More often than not, it's a group effort, whether that's brothers or sisters, uncles or extended family, all sharing this one estate. But when it comes time to report that sale on taxes, the IRS does not care who handled the paperwork. What they care about is how the home ownership and the income is divided. That's where the families tend to get tripped up. And how the IRS sees it is if there are multiple heirs, each person technically owns a portion of that property. So when the home is sold, each heir is responsible for reporting their share of the capital gain or loss on their own tax return. The title company or closing attorney will usually issue a Form 1099-S for the sale. If that form lists only one heir's name, then the IRS is going to assume that that person received the full proceeds, which can trigger a tax bill far larger than what they actually received. Here's a real-world example. Let's say 3 siblings inherit a home here in Hamilton County, which is in Chattanooga. Let's say that home is worth $300,000 and they sell it for $315,000. After closing costs, they split the proceeds evenly, $105,000 each. But the 1099-S only lists the oldest sibling as the seller. Now, come tax season, the IRS sees that form and assumes that the sibling alone received the full $315,000 and expects them to report any taxable gain on that amount. Sorting that out later takes time, paperwork, and sometimes amended returns, which all can be avoided with a little planning upfront. So let's talk about how you can fully avoid this mistake. Clarify ownership early. Make sure the probate paperwork or deed reflects all heirs before the sale closes. Coordinate with the title company. Ask them to issue separate 1099-S forms for each heir's portion of the proceeds. Keep records of who received what. Bank statements, closing disclosures, and wire confirmations can all help prove the breakdown if the IRS asks you. Get tax advice before closing. A quick conversation with the CPA or an estate attorney can prevent a months-long headache later. So selling an inherited property already can be emotional, as we know, but the last thing that you need is confusion at tax time because of a paperwork mix-up. Trust me, you will be doing yourself a favor. Now let's dive in to advanced tax strategies for Tennessee inherited properties. This is where things tend to get a bit interesting, so bear with me here. After working with hundreds of families on inherited homes across Tennessee and across multiple counties, I've seen a handful of strategies that can legally save thousands in taxes, but very few homeowners, and honestly, some CPAs never even mention them. These aren't loopholes and you're not doing anything illegal, but they are smart documented methods for protecting your family's equity and planning ahead. So let's get right into them. The 1031 exchange possibility. So if the inherited property was used as a rental or an investment, you might qualify for a 1031 exchange. And a 1031 exchange allows you to sell one investment property and roll the proceeds into another, deferring your capital gains taxes in the process. It doesn't erase the taxes, but it does buy you time and it preserves more of your working capital. And here's how it typically works. The property must be considered an investment or income producing. So this is a strategy that a lot of investors use. You must identify your next property within 45 days of selling and close within 180 days. You need to use a qualified intermediary to hold the proceeds. You cannot touch this money yourself. And there are plenty of 1031 exchange companies that I'd be happy to refer to you if you just reach out to us directly. Now, this is the most effective when the property you inherited was already being rented out. So for families who are managing multiple homes or potentially small portfolios, a 1031 exchange can keep growth growing instead of having to give that big chunk away to the IRS. Again, this is something that most smart investors will use as a strategy when they're selling a property. Next up is the primary residence conversion strategy, which we already lightly touched on. Now, not everyone wants to sell right away, and in some cases, they're not wanting to pay it off right away. So if you move into the inherited home and you live there as your primary residence for at least 2 years, you may qualify for that home sale exclusion up to $250,000 in tax-free gain if you're single, or again, $500,000 if you're married and filing jointly. Now that tax benefit alone can be life-changing and make a huge difference. I worked with a client in Signal Mountain a few years back who inherited a small home valued around $420,000. She lived there for a few years, she made a few updates, and later sold it for $515,000. But because she met the 2-year rule, she paid no federal capital gains tax at all, saving just over $31,000. And yes, we were pretty proud of that transaction. It's not the right fit if you need to sell fast or if you need to split the proceeds with multiple heirs, but for the individuals who want to take their time and make the property their own, then it is a smart long-term play. So if you know a family member that wants to move into the property, you could potentially do this. The installment sale or tax-deferred owner financing. This is another powerful, lesser known approach in selling the property with owner financing, also called an installment sale. That's a little bit more typical. Instead of taking one lump sum payment and one big tax bill, you collect several payments over years to come. The IRS only taxes you on the portion of profit that you receive each year, which can help you in a lower tax bracket and reduce your overall tax exposure. So for example, if you sell a $400,000 property and finance $300,000 of it over 5 years, you'll report roughly 1/5 of capital gain each year as the payments come in. Now, this can work especially for family-to-family sales or investor buyers like ourselves who are comfortable making monthly payments. We've had several homeowners seller finance properties to us, and now it does require proper documentation, so don't get into bed with just anybody. You need a promissory note and you need clear default terms. So always work with a Tennessee closing attorney or a real estate attorney or title attorney who understands installment contracts. Now let's talk about confirming the step-up basis the right way. So the stepped-up basis is one of the biggest tax advantages you get when inheriting property, but only if you document it correctly, like we mentioned before. The IRS doesn't automatically know what the property was worth when your loved one unfortunately passed away. And if you can't prove it, they can assume the original purchase price, and that's where huge unnecessary tax bills come from. So here's how to lock in your stepped-up basis the right way. Number 1, get a professional appraisal dated as close as possible to the date of death. Number 2, keep copies of that appraisal with the death certificate, the deed, and all the entire paperwork that you've collected up until this point. Documentation is so crucial. Number 3, if an estate tax return is filed, Form 706, ask your CPA to include Form 8971 with the property listed on Schedule A. This makes the step up official in the IRS record. And if no estate filing is required, your appraisal and local tax records are typically enough proof. So save these documents, even if you're not planning to sell soon. 10 years from now, that paperwork can be the difference between keeping your inheritance or giving the IRS tens of thousands of dollars that you don't actually owe. And again, I have seen this time and time again. And another strategy is using trusts or charitable strategies. For higher value estates or families who are thinking about long-term legacy planning, trust-based and charitable strategies can offer both flexibility and protection. A revocable living trust allows ownership to pass privately and smoothly without delays of probate. It doesn't eliminate taxes directly, but it does ensure the property still receives its stepped-up basis and prevents estate disputes later on. So for out-of-state heirs or multiple heir estates, this structure can make the process much simpler. No court delays, no paperwork, and no waiting on signatures from every heir, which is a literal nightmare. So think of a charitable remainder trust, a CRT for short. A charitable remainder trust is a more advanced strategy that lets you sell the property tax deferred while also supporting a cause you care about. Pretty cool, right? Here's how it works. You transfer the inherited home into the CRT. The trust sells it, often without immediate capital gains tax. You receive steady income from the trust each year for a set term or for life. And when the trust ends, the remaining value goes to that charity that you choose. This can reduce your taxable income, defer capital gains, and create a meaningful legacy all at once. These trusts must be structured carefully, so please do work with a Tennessee estate attorney or a licensed CPA professional who both understands charitable trust rules. Tax strategies are one part of the equation. Protecting the sale itself is the other. So before closing on an inherited home or a probate home, let's go ahead and consider a few extra layers of protection. Number 1 would be enhanced title insurance. Standard title policies don't always cover probate-related risks. Spending an extra $200 to $400,000 can prevent tens of thousands in potential claims. Number 2, attorney opinion letter. A short letter from a probate attorney confirming that title is clear can speed up the closing and build confidence with serious buyers, especially if you already have someone on the line. Number 3, conduct a comprehensive lien search. So go beyond the basics. Confirm there are no IRS liens, no state tax liens, no Medicaid recovery claims, or no 10-care liens, or old contractor liens still attached to the estate. You will be surprised what comes up when you do a thorough and extended title search. These extra steps may seem simple, but they turn potential roadblocks into non-issues, and they show buyers that your transaction is clean and ready to close, which of course any buyer would prefer. My take is that not every family needs complex tax strategies, so don't get caught up in the world of having to hire the best attorney in town. Most of the time, the biggest financial wins come from just simple documentation or simple preparation. Documenting the property's value, understanding timing, and asking the right questions early to the right people, like your CPA, your estate attorney. But if you're dealing with a rental or a larger estate or a home that's appreciated significantly over the years, these advanced options from 1031 exchanges to charitable trusts can make a six-figure difference when used correctly. So my advice is not to wait until closing or a week until closing to ask about your taxes. Spend 1 hour with a Tennessee-based CPA or an estate attorney who handles inherited property sales. That single step can save you months of stress and put more money in your pocket than you may have ever expected, which is pretty neat. And believe it or not, selling an inherited home isn't just about speed sometimes. It is actually about strategy. And when you plan ahead and you protect both your profit, you will protect your peace of mind. Well, now you've got the roadmap. and you now understand, hopefully, how Tennessee tax rules actually worked, from that stepped up basis to capital gains to those hidden costs that nobody mentions until it's too late. And you've learned to protect your inheritance from unnecessary taxes and how to plan for the long game if you're thinking about holding, renting, or reinvesting. But here's another challenge that most families face, one that no amount of tax planning can completely prepare you for. And that's what happens when there's more than one heir and not everyone agrees. So in our next video, we're diving into something I see all the time here in Tennessee. We'll talk about what really happens when brothers and sisters or extended family members cannot agree on selling, splitting, or keeping the home. And we'll talk about the smart ways on how to avoid turning a family inheritance into a full-out family feud. It is one of the most emotional and toughest parts about this process, but there are ways through that to protect the relationship and keep everyone moving forward on the same goal. So if you're currently navigating an inherited property and you want to understand your options before family tensions or tax surprises pile up, let's talk. There's no pressure when you call us. You can get in touch with us in the information below here in the captions. We'd love to help you and set a plan forward on helping you sell your inherited property here in Tennessee. And please don't forget to catch up on the next video. This is the 4th video of our probate series where we go all into heir disputes, and we'll be finishing up this probate series talking about how to sell your house fast for cash. Thank you so much for watching, and we'll see you in the next video.